Everyone. So, what are the advantages and the disadvantages of converting your existing business to a C Corp after the 2017 Tax Act? A lot to talk about today on 10 at 10. So, let's go. Good morning, everyone. So, Paula Mattisonsierra here, Power Marketing SF and host of 10 at 10. Thank you guys for tuning in today. And for the guys on the re-ear later, appreciate you so much. Today on the show, we have Stuart Sorkin, Esquire, of Business and Legal Advisors. So, Stewart's consulting firm specializes in the financial and legal protection of business owners, executives, and entrepreneurs throughout the US and overseas as well at every stage of their development. And today we're going to have Stuart on the show. Stuart, welcome to the show.
Good morning. Thank you for having me.
Hey, Stuart, thank you so much for being on. These changes happens, and of course, we can either be knee deep in it trying to become attorneys, or we can just consult an attorney to let us know and an advisor to take us on this journey. I'm gonna step back here, and my big first question to you is catch me up. What is it that we need to know about this?
Okay. In 2017, the corporate tax rate was cut from 35% to 21%. And it also maintained deductibility of state corporate income taxes. When you compare that to the maximum individual rate now of 37 and non-deductible state income taxes, you are talking about between a 10 and 15% swing or more in your after-tax dollar cost. So if you are trying to grow your business, wouldn't you rather pay, in California, I think it's 26.4% effective corporate tax rate, and then have 74% to reinvest in your company? Or would you rather pay probably in excess of 45% in taxes to California and only have 55 cent dollars to invest in your business?
Yeah. Feels
And
like
this
a
is not for
no-brainer.
everyone.
Yeah.
This is not for everyone. I want to clarify.
Yeah, because
This,
that's
this,
one of
this,
the questions that I had as well. It's like, is this, I mean, sounds like everyone should be doing this, but really, is it right for everyone, you know?
it is not right for everyone, and we'll talk a little bit about some of the factors to look at. But clearly, this is for someone who is already, the founders are already in the maximum tax bracket. They have decided they want to grow their business, or they want to do things within the business, and we'll talk about that in a minute. Then this is something to consider. There are clear disadvantages to making this, but the issue is that if you are going to grow, my view is that if you are going to grow your company to the next level, there are two things that entrepreneurs must look at. One is capital to grow the business, and two is willingness to delegate, so they are creating something that is more saleable.
Absolutely. So, of course, my ears pick this up, and that it was the title of our show today. What are the advantages of making a move like this?
Okay, well, as we said, a big advantage is investment, having a significantly lower tax rate, which means you have more dollars. Well, what could you do with those more dollars? Well, if you're going to acquire a company, wouldn't you rather, and bank is not going to finance 100% of it. So if you're going to accumulate cash, wouldn't you rather accumulate it with 75 cent after tax dollars rather than 55% after tax dollars? Second issue is, if you're going to pay back debt, wouldn't assume you've already acquired a company and you have to pay back debt, wouldn't you rather have better tax dollars? Alternatively, there are some other things that people can do. One is that if you own a C corporation and you are already maxing out your pension benefits within the company, the C corporation is the only entity where a founder or an owner can also have a non-qualified deferred comp plan. So the idea here is that you can invest more into a non-qualified deferred comp plan because the taxes are lower and you can reinvest it and then take the assets out at a later date. Another significant reason and difference between C corporations and S corporations is that S corporations restrict you to basically one class of stock, either voting or non-voting.
Oh, okay.
If you are trying to bring investors into your company, most investors are going to want a liquidation preference or some kind of redemption feature. So additionally, they aren't going to want necessarily to have the company have to distribute cash to pay their taxes because that's cash that they've just invested in the company to grow it. So they're actually reducing their ability to invest. So if you need investment capital, a C corporation is better because you can create a class of equity just for investors. The same thing is true if you need to golden handcuff key employees. Actual equity is probably the best way to go, even though it's probably a little more complicated, because if you actually have stockholders, employees who are stockholders, currently under state law in most states, you can't enforce a covenant not to compete against a pure employee. However, if they are a stockholder and you are saying a portion of the purchase price for that stock is being allocated to a covenant not to compete that's going to be paid over the covenant period, you clearly have an enforceable covenant against that employee. There are some other things you can do with the employee class of stock that we could get into at another time.
Yeah.
Another issue is the ability to have a tax year other than 12/31. If you are a government contractor, wouldn't it make more sense to have a September 30 year end, which ties to the government? If you are a retailer, wouldn't it make more sense to have a January 31 year end because you have all the returns at Christmas, after Christmas?
Yeah.
So looking at when you can, that portion of it is really another factor to consider. So you have the flexibility of, you also can have a medical reimbursement plan within a C Corp that the founder can participate. That is probably one of the major issues of being an S corporation stockholder versus a C is, as owners of S corporation stockholders are restricted on certain types of benefits that they can receive, like non-qualified deferred comp, like health insurance, payment of their health insurance, and other things. So certain benefits can be offered that way. So there are a number of reasons why someone would want to look at this, but they also have to look at their own individual tax rate.
Yeah.
If you're not in the maximum tax rate, if you're in the 30% tax rate, and with state taxes you're at 35, this may not be worth some of the two major disadvantages. But let's talk about the disadvantages
Yeah.
that
Yeah.
come into play.
You,
First, most people, go ahead. I'm sorry.
no, I was just going to say, before we get to the disadvantages, actually, like, I guess cut in the middle of that, because I find that when I get to my clients and they're making any changes, I often hear them go so quickly to LLC. It's like the trend right now, right? And what I'm hearing from you loud and clear is this is also a great time, even though it's taxes and it's slightly separate from it. It's time to really sit down and think about what your plans are and what do you want and how do you want to grow and move forward. Because, like you
And
said, if you're bringing in investors,
They're
That's
going
going to
to
be
they're
fun.
clearly going to prefer a C corp, and also you can only make a an election to convert from S to C. You can do it annually between the first of the year and March 15th.
Yeah.
After that, you are required for the entire year unless you take an action which actually terminates your election. So this lecture is sort of timely. That is the time to look at it now of whether or not it makes sense
Yeah.
to make this election for calendar year 2023 or not. And as I said, it's not for everyone, but for certain people, it is clearly advantageous.
Well, let me ask you.
Why wouldn't?
I'm sorry. Go ahead,
Oh, sure.
Stuart.
I said, why wouldn't?
Why wouldn't you? Oh.
The big issue you always hear from everyone is double taxation. And the concept is that if there's money in the company pays tax on it, and then if the founder wants to take it out, they have to pay capital gains tax as a dividend. However, with a corporate tax rate of 21% and a capital gains rate of 15%, that equals 36. If the maximum individual rate is 37, there really isn't double tax right now, first. But secondly is this. I don't know that I'd work with any client that couldn't tell me by early December within 5% where we're going to end up for the year. If you do not have good enough financial records to be able to project with fairly reasonable accuracy what your income's going to be, what your taxable income is going to be in December, then this is problematic. If, on the other hand, you have the ability to do that, then you can say, okay, I want to have $400,000 left in the company for next year for other things. So you leave $500,000 in the company, and then you declare a bonus to the founder for anything that's over that.
Well, let me
And
ask you a question, by the way, because
sure.
this is like setting up for. I know that when you guys come in to advise your clients, you're not just looking at the finance, you're looking at the management of a company, the financial structure. Tell me about that, because I know that you're not automatically starting with taxes. Like,
No,
you know what I mean?
it's really
How do you
well.
start engagement wise? How do you prepare a
Okay,
client for this stage?
the first I look at it that there's really three main things we have to look at to start this. First, has the owner figured out his plan for the business? And what I mean by that is, has he met with a financial planner and run a Monte Carlo analysis to see what he needs out of the business to have a successful retirement? Does he have family in the business and outside of the business? Does he have what has he done to plan for a planned or unplanned exit for the business? You know, the common question is, what happens to your business if you walked out of this meeting and got hit by a bus? What happens to your business? How do we protect the business? How do we protect the business if something were to happen to you? Once you have each partner has done that, then you have to have the partners meet to make sure their goals are aligned. Because if one partner is running the business more like a lifestyle business and one is running it to grow it, they are potentially making decisions that are actually contrary to one or both of their goals for the company.
Yeah.
So the point is that you have to have, in my mind, alignment of goals for partners, looking at a 3 to 5 year term and creating milestones to see if you're getting there and making sure that your employees are all aligned with those goals. And then lastly, the two keys to success in my mind for growing a business is the entrepreneur has to move out of the way. And what I mean by that is, unless you're willing to delegate, you will never create significant value in your business, because the problem is when you sell the business, the one difference is you're not there. So if the business doesn't run well without you, and it won't run well without you if you don't delegate, that's a problem. And the second area is, what kind of capital do you have to invest in the business? Can you reduce your lifestyle, or can you live on less money and be able to invest in your money using the C corporation issue as one of the things?
Nice, nice. And does your business, does your consulting practice help with this as well? I
Yes.
mean, it's one thing creating the plan, but are you more of like an experienced manager? Do you come in and actually take them through the process?
Yes, the object here, what will happen is that I would meet with each of the founders individually, hopefully crystallizing their goals. And then I give each of the founders a questionnaire that I ask them to fill out separately. And then we play a game of Texas Hold'em where we talk about what are the strengths of the businesses? What are the weaknesses of the business? What are your strengths to the business? What are your weaknesses? What do you love doing? What do you hate doing? What do you do when you're not working? Now, 5 years from now, tell me about the business. Tell me your role in it.
Yeah.
So we can hopefully build consensus around that piece of the puzzle. I've also learned from them, hopefully, something about the management team. I've also learned something else, because as I said, one of the key issues in a successful transition is delegation. Well, with most entrepreneurs, you will pry control from their cold, dead hands. However, I've asked them a question. I've asked them something they hate doing,
Yeah.
and it's this percentage of time. So now I can say to them, I know you told me you hate doing this.
Yeah.
I know you don't like to delegate. You want to try something different? Because the object here is that every businessman will sell his business in one of 6 ways, and only one of 6 ways. He will sell it to family, he will sell it to management, he will sell it to a third party, he becomes an absentee owner, it gets liquidated, or he dies. If you do not pick one of the first 4, the last 2 will happen. However, the best way to sell a business or run a business is as an absentee owner, because then you're not needed. You can do what you want to do, and you will also have the maximum value for your business, because when someone buys it, they don't need you.
Well, let me ask you a question then, like to roll back to our main topic, because it's, of course, I'm hearing this and it sounds all good to me. So I really wanted to hear how your business tackles it as well. And of course, my ears picked up very clearly the business owners at the heart of any of the challenge. As always, we're the stumbling block, right? We're the
Yep.
thing that kind of blocks off the vein a little bit. What's the cost of not making this move, especially if you're in the right position? It's like
Well,
I'm nervous. I don't want to do it. It sounds a lot. What's the
well,
cost of not?
here, let's talk about it for a second.
Yeah,
If we assume for a minute, let's just assume 15%. If you can put 15% more money in your pocket, whether through directly through the corporation or indirectly from the corporation, tell me how that's a disadvantage.
don't give me more money back, Stuart. I don't want it. I don't
Right.
want.
Now, I mentioned the double tax. So, but which is, concern potentially. However, certain industries like government contractors, for example, I don't know a government contractor who doesn't know the exact pay schedule of every one of their agencies. So they know if they send out a bill on December 1st, they know whether they will get paid by December 31st or not. So if you know your client, your pay cycle, if you want to lower your revenue, you just don't send out the bills on December 1st. You send them out on December 15th. If you want to accelerate revenue because you have places you're going to spend it and you know it, then you factor that into your calculation of what the tax liability would be. That's the other piece. As I also said, the other issue, the other significant disadvantage of becoming a C-Corp is that probably the vast majority today of merger and acquisition transactions are asset sales, not stock sales. And therefore, on an asset sale, you would face a higher tax than you would on a stock sale, because all of the assets would have to be sold by the corporation. The corporation would pay tax on that, and then it would distribute out the profit, to the founders. You can partially structure around that because a founder might be entitled to personal goodwill because he is such a key part of the business. So you can possibly, if you had a stock sale, say asset sale, you could avoid some of the double tax. The other issue, though, is that, as I said, certain industries like GovCons are almost always going to sell as stock deals. Stock deals also will work. Sometimes is really the question is whether or not the buyer is really going to get a major advantage from a stock deal. Because if you're like in SAS or something that is not heavily equipment oriented, then there's not going to be, then the buyer is not going to be as concerned about increasing the depreciation, and all they're losing then is a write-off over 15 years of the goodwill.
Yeah.
And potentially, given the tax considerations, there's can be some play between purchase price and the tax considerations to make this work.
Well, let me barge in then with another question. It's like, all right, I'm in the perfect position. I'm ready to do this. How do I begin this process? If I'm not, if I don't have a Stuart Sorkin,
Well, what I
should
would suggest you do as a starting point is, assuming you have at least that you are using someone who does tax preparation, that is reasonable on doing tax projections, I would have them say, okay, let's add back, if I'm an S Corp, let's add back all my distributions, and let's figure out what the corporate tax would have been. And now looking and saying, okay, if I kept the money that I ended up leaving in the company after I took my tax distribution out, how does that compare on an after-tax basis than if I had been a C corporation and I had paid that tax at the lower tax rate? So it's a comparison on that.
Yeah.
It also would depend on how quickly you're going to sell. If you're going to sell it in 2 years and you're not a company that's likely to sell as a stock deal, it's probably not as good a deal for you. If you're going out 5, 7, 10 years, then the tax savings and the accumulation of cash that you may be able to do, or benefits that you can do, may be worth it. And then again, if you're in a situation where you need significant capital to grow, then a C Corp is likely going to produce a better result also, because banks tend to like to lend to C Corps rather than S Corps, because they're not as worried about the intermingling of the personal side and the business side that you have with the S Corp.
Okay.
And I will also tell you that I have a number of clients who converted because they got tired of getting the surprises in April from their accountants with regard to the tax liability. Which is also one of the reasons why CPAs are not as fond of making this election. And you have to take their advice potentially with a grain of salt, because if they mess up in a C corporation, there's double tax. If they mess up with an S corp, there is no double tax.
Yeah.
So the client is not going to be as upset with them if something happens. And in fact, I had a meeting with a client and a CPA the other day, and I ticked off all of the reasons why someone should be a C Corp, and he agreed with me, and he said at the end, I still would never elect to be a C Corp. So that's a problem that I think that some people just aren't aren't willing to accept that there are changes and that maybe it's a little more work, but if you're going to make your client a lot more money, it's probably worth it to consider.
And you make a really valid point here. Sometimes as the business is growing, it's okay to evolve to new people. This kind of reminds me of the book Think and Grow Rich, that chapter on seeking specialized assistance. If you're at this point, it's time for you to get specialized assistant. And the person who started on the first phase of the journey may not be the person who moves you to the next season. And that's okay. That's okay. But it's time to maybe look for others and keep moving, and that's fine, you know. I'm gonna wrap up the show because I feel like this is such a big one. We can speak about it for days. If folks want to stay in touch with you, by the way, I know I'll drop the link in. Stuart offers a free consultation. Um,
Let me clarify.
okay.
I offer a free consultation to any person who would like it. However, before the consultation, I will send you out a 2-page questionnaire that I will ask you to fill out regarding the basics of the business. Because if I'm going to spend a half hour with you, I don't want to spend most of it learning about the business. I want to have a basic understanding of the business before I start the call, so I can hopefully give some advice that is beneficial to the client in the call.
And also to be fair to you as a business as well, you want to make sure that it's a proper match for you. Can I even help this person where they are? Can I jump them off and help them to be successful here? All right, but a little birdie through our networking pile shared with me that you have a book. Can you talk to me about it? Look at you, marketer already. You have your book right there. Tell me.
Okay, Expensive Mistakes When Buying, Selling Businesses came out in January of 2010, and I'm proud to say that it still has 4.5 stars on Amazon. I co-authored it with a client that I helped sell his government contracting business. And basically, it is 57 different mistakes that we spotted and talk about the mistakes and how to correct them. And it looks at it in 5 chapters. Chapter 1 is the chapter regarding starting a business. Chapter 2 is a buyer who's looking to buy a business. Chapter 3 is the actual transaction from the seller standpoint. Chapter 4 is the buyer side of a transaction. And 5, which is probably the most ignored, is integration. If you were ever doing an M&A deal, if you do not have at least 50% of your integration plan completed prior to closing, you are not going to have an efficient bringing in of that company, and it's going to cost you time and money.
Okay. All right. Good to know. Well, I think many of us do run our businesses, and we don't really give a lot of thought to the exit portion of the business, the exit strategy. I used to work for 2 of the counties here, and they would always do these business planning classes. And I have to say, we would focus so much on the operations or starting the marketing, and there was no mention oftentimes of the exit strategy portion of it. I think the thought was, oh, they're brand new businesses, they don't need to have this conversation yet. But the further along I am in my own business development, I realize that's a conversation that should be placed front and center, and then you work backwards, right? Where
Yes,
are
well,
you
and
in X and go backwards?
whether you're a startup, a maturing company, a growing company, or you're working towards succession, you have to have a plan on how you're going to get there.
Yeah. Yeah.
And you have to have goals.
Yeah.
And the other point I'm going to make to you is that if you have partnership is like marriage without sex. The only thing that brought you together was create a progeny called the business. The only things you're going to fight about are money and control. Your buy, sell, and or operating agreement is your business prenup. It needs to be done early on in the transaction, because the longer you wait, the more likely someone's ox is going to get gored, and you won't have and then you will end up in a divorce without an agreement, and that is an awful situation.
It sounds like you're doing marriage counseling right now. Maybe the marriage counseling guys should also be on this call as well. But
Well,
listen,
it's the concept is that if you don't have the same goals for the business, you're not going to make the same business decisions.
absolutely, absolutely. You know, well, listen, guys, if you want to hear more, I will drop the Amazon link in for you. You can read the book. If you want to get in touch with Stuart, we will drop the item in. Remember, there will be a qualifying questionnaire that will be sent out to you ahead of schedule to see if you're a right match before you move forward. And of course, if you want to hear about marketing, I offer the same thing as well, 30-minute consultation. And you're getting a quick questionnaire to find out if you're a proper match for me. The continued mission, as always, is to introduce you to everyday experts like Stuart. Thank you, who will share their expertise to uplevel you. And of course, I'll be offering marketing tips to you as well. We here every Thursday at 10 a.m. live on LinkedIn. And of course, you can catch a replay on my site. Thank you so much to everyone who's watching today. But Stuart, close us out today. You have a quote that you absolutely love that I think is perfect for today.
Well, first, I want to thank you for the audience for their time. I hope they found it interesting. And exit strategy begins the day you start your business, because if you don't know where you're going, how are you ever going to get there? Thank you for your time.
Thank you so much, everyone. Have a great rest of the day. Bye, everyone.